For traders that have emailed and asked, the links for the free downloads are in the description box below. Just click on the link or copy and paste and put that in your browser. The 4-step method to high performance trading and the 7-step daily routine for high performance traders create the rituals, the mindset, and the winning attitude to master the markets. Bulletproof yourself with your daily routine and your habits. Force yourself to be getting better, 1% better every single day. How good can you get, traders? Again, the free downloads, the links are down below. They're both free courses. Let's get started. Good day, traders. Stacey Burke from Stacey Burke Trading. Today, we're talking about filtering out the best pairs to identify your trading setups in the session that you're trading now. Primarily, again, a lot of questions, a lot of great feedback, and a lot of really good questions from traders, specifically dealing with not only New York, but the other sessions that you're trading. So you can substitute New York Open for your London Open, or if you're trading in Asia, again, I like to focus on that middle hour. So the timings 8 to 11 p.m. Get a piece of paper, 8 to 11 p.m. for Asia, New York time, 2 a.m. to 5 a.m. for the Europe-London window, specifically 3 to 4 a.m. for that London Open. Then, of course, the U.S. session, 8 to 11 a.m. New York time, and specifically 9:30 for the equity market opens. I like to focus on the equity market opens. Again, it just allows me to have a real consistency. There tends to be, obviously, sometimes pre-market entries prior to that, but lo and behold, the textbook setups seem to come right around that New York Open. So I'm looking specifically not to sell the highest price of the day or buy the lowest price of the day, but when my thesis is confirmed, if I have a short trade, the high is locked in, and I'm going to be shorting it. Depending on the template, the day count, we may have a high of day, low of day trade setup, as we had on gold today. We may have a low of day, high of day setup, short squeeze, as we had on oil today. We had major news on the calendar, ADP at 8:15 New York, 8:15 a.m. New York time. And again, I do not trade the news. I repeat, I do not trade in front of the news. I will be, if I am in the market, because I've got half an hour, 45 minutes, even 15 minutes, if I have an ideal setup, that trade should be well and truly either finished by that point, profits locked in, or the majority of that trade taken off with profit, leaving a trailer for the news to act potentially as a catalyst to complete the move. A very small portion where my risk is minimal, even if there's slippage on a spike stops me out. Very unusual. Usually when a move is in its process, the news will act as a catalyst. We had Fed today. And again, I'm going to go over the simplest way that I filter out the pairs in ways that I avoid pairs on certain days and when those rules have an exception. So again, there's 3 types of trades. Just going back to number 2, you're either at the high of the day, the low of the day, high of the week, low of the week, or you're inside. And if you're inside, it's not to say that there won't be a trade, but when the market opens, you want them to revisit one of those extremes. When the market opens, they can be taking traders into the false move at the beginning of the equity sessions. If the high or low is already locked in, when that market opens, we should have a squeeze for a catabolic explosive move, as we saw yesterday, and we saw it again on oil. We saw it on gold today. We saw an all-day fade. The market was locked in, and the market just proceeded to drop down in gold. Oil, the market drove traders back into the low of the day for a short squeeze reversal that went all the way back to the high of the week. So again, there's 3 types of trades I'm looking for. Reversals, trend trades, or just a high-low trading range for a scalp. Sometimes that scalp may be 50, 100 pips, depending on the instrument that you're trading. It may be a day 3 where that trading range itself is a sizable opportunity. Again, you have to understand the day count, the template. And again, I think some traders are really starting to nail these. And then it's as simple as putting your entry in, putting your stop in, and making sure that you take profits. I like to pre-program the majority of my positions to be locked in with profit as it's blowing through that level. Something Bill McLaren taught me years ago that he learned from one of his mentors, 40-year Wall Street veteran. That's right, 40 years on Wall Street. Just imagine, he didn't just hear these concepts from somebody in the last 10 years. He was on Wall Street for 40 years. And that was over 10 years ago that I learned from him, Bill McLaren. And one of the things his mentor told him was learn to take a profit. So I like to pre-program my levels, and when the market's accelerating, it blows through and takes me out. And if I have trailers in, I will accelerate and look for if there's any sign of that market to reverse, to lock in that profit. Or if I feel that it has the potential to continue to move for an all-session trade, in the U.S. especially, I will adjust my stop accordingly and give that ample enough room because I've taken the majority of that profit off. And again, once I'm done, stop trading. Stop trading. We talked about this. Every single video I will repeat the same thing. Stop trading. Don't sit there all day like a junkie trying to catch every little move. Learn to identify the best setups and learn how you can scale them up in size. Take 1 or 2 really good trades rather than 10 little piker scalps with no size. Learn to scale repeatable setups up in size, and then review your process, your live performance executions, your mindset. How did you interpret the data? How did you process it? How did you execute on your trades? Were you able to be patient and wait? Were you chasing moves? Did you get out too soon? Did you trail your stop and get break? Did you trail your trade and get stopped out? I don't trail stop trades. And again, my stop is in place at break even once it blows through a peak formation high or low. Then I let it go to its profit target, and I'm using time decayed to determine whether or not I will close the trade out if it has not hit my target. If it's an explosive move and there's any sign of hesitation, I will then look to exit the trade manually. If I leave a trailer in the market, it will be with plenty of room for that market because my thesis would be that it has the potential to maybe, like S&P can go 750 pips. So I may leave a position that continues to trail, but I'll be giving that trade plenty of room. Traders that trail these 25, 50 pips, it's nothing for these markets to spike into those, and the algos know how to do that. So again, today looking again, I'm just going to review and hammer home over and over again. Somebody had a great point yesterday. How did I know that S&P wasn't trending? Understand that I look at the high and the low as my areas for setups. Everything inside, listen, let me repeat this. Everything inside can be anything that you believe it to be. And that's what they want you to see. The day itself becomes order flow. The day itself, the entire box can become order flow. So I work from the high and the low. If the market has not broken one of those levels, I will look for something that has a better setup. I don't try to trade one thing all the time. When I go to the screen, I go through the major pairs, oil, gold, NASDAQ, S&P, and I am looking at Dow Jones 30 as well. Day 1, day 2, day 3. We're on Wednesday. As I've talked about, my best sizable trades will come at the high and low of the week. When we're inside, and any time I look at these charts, I talked about 3 peaks, but most of the time that will be on a day 2. 3 peaks is on a day 2. Write that down. Typically, a 3 peak, high of day, low of day trade from one extreme to the other will be on a day 2. We're inside on day 3. Now, for traders who are trading this, again, I would mark off my levels, high and low, that's it. But I would not even be looking at this pair. I want to see, understanding when I'm looking for 3 levels of rise, we can have a Monday, a Tuesday, and a Wednesday. And again, this is a textbook sort of representation, but you're not always going to get that. We can have, as we saw on gold, we can have a day 1, we can have a day 2, we can have a day 3, and then we can see a nice sizable move. Point I'm trying to emphasize is that I want to be working with pairs that are at this level. So we had an example on oil today. They came down and made a low of the day in London. They broke the high of the week, came down and made a low of the day in London, and then proceeded to push back down into the low at the New York Open, and then an explosive move, reversing back through the high of the week on day 3. So understand that even though we'd broken this level, this market now is on my radar. They've put a low of the day in. We got a high of the day. London traders had an excellent high of the day set up in London. They broke down and went right back up into that level. Peak formation up for a short trade in London for oil. London puts the low in. London put the low in, the high in. And then New York opens up, creeps back into the low. Boom, short squeeze back to the high of the week. Day 1, day 2, day 3. If we're inside the exception, so just to reiterate this, the exception to the inside day is this. We take out the high of the week on a Thursday, for example. Market comes back down at the end of the night. The next day, traders are looking at the high of the week and maybe the low of the previous day. And this market, though, has failed in its breakout. This is a failed breakout at the high of the week. Thursday's high, breaking out of Wednesday, did not hold. This market goes into a consolidation rectangle and boom, rolls over and breaks down. The inside day, maybe on a Friday after the high of the week or low of the week, breakout has failed. Important to understand that the exception. Now, I did talk about day 2, and I'm going to keep reiterating these and going over these on a day 2. So, for example, we have a market that comes down on day 1, and the next day, we have our day 2. The next day, the market proceeds to go up Asia, London, New York, and goes back to the low of the week. Day 2. And it can happen in the long direction as well. We can have a market that, again, breaks through, and when we get our rollover, and sometimes it might even go a bit further, then it proceeds to auction back down Asia, London, New York for the move back to the high of the day. Again, the whole day becomes order flow. So important to understand that when we don't have a level broken, I typically will not look at those pairs. I don't want to get caught up in markets that are going to potentially be choppy and difficult to move and not necessarily go anywhere. Again, the exception being after we've had a failed breakout at the higher low of the week, day 1, day 2, day 3, up high for a big move on a day 4, no news on the calendar, that sort of situation. So again, understand the escalator. If I want the escalator to work for a large move, I want one of these levels broken. So again, Canadian dollar, not on my radar today. Swiss franc. Again, the US pairs, I'll typically put them in a basket. And understand this, there are going to be traders that traded these instruments. I talked about this yesterday. We could have broken structure on Swiss franc on day 2 inside. We had day 1, day 2, day 3, Monday, day 2, Tuesday, break-in structure on the inside. This market has still failed to go up higher. Now, it may break tomorrow's level and still fail inside of the high of the week. Don't know. Have no idea until I come to the screen. But today, not interested in this pair. Pound yen, same thing. You can go through these on your own charts. It broke initially in Asia before pulling back and then continued to break down in the London session. Lower peak formations. And again, when a market breaks through like this, so again, still on the front side of the move, trend lines, whatever you want to call them. Front side of the move, still creeping trend day 1, day 2, day 3. We want to see a peak formation high for a continuation trade short through the low of the day. The process is low of the day, peak formation high in the London session, first hour pins up on ADP. The last lower high that was made is holding. They break structure heading into the new hour, and they auction back up into the high. 1 push, 2 push, 3 pushes, engulfment right at 24 minutes into the second hour, just prior to the New York Open. 3 pushes into the high at the quarter level in a broken down market on day 3. Okay, it's a 1 bar stop. Nothing complicated about this. We are looking for these trades for a 50 pip move back down through the low of the day into the low of the week. It's as simple as that. Crude West Texas, day 1, day 2, day 3, London high of day opportunity. So again, the market broke down heading into the Europe-London window. And again, our London Open pin peak formation stop hunt back into the high of the week from Tuesday. So the market breaks down, we get a high of the week opportunity. We want to see the stop hunt back up into the high of the week. West Texas spot crude, we had day 1, day 2, day 3. And we had a high of day opportunity to sell high at Tuesday's high in the London session today. First thing that I'm looking for is, has this pair broken a level? The sell high came in the London session. High of the day opportunity, and again peak formations are up. So the market breaks down heading into the window, and again just noticing 1, 2, 3 London Open. The sell high came up top at the outer boundary. So this is my trigger when it's outside like this. So somebody, we'll talk about this in a second about what's happening inside. So the last leg of this move from the US session, the last low, where this move began to go up, was at the end of the session. The low of day has already been taken out. So what that tells us is that the low is not yet in place. So there's 2 things to consider. Is this market going to pull back and keep going lower? Well, we're in a market that is day 1, yesterday, first day of breakout traders on Tuesday. Day 1 for the 3-day cycle is up top. Sorry, day 1 is Monday for the 3-day cycle is down low. That starts our day count on the way up. They break out. That's the first day longs are in the market. Day 2 longs are in the market at the break of the high on Wednesday. But they also gave a high of the week sell, high of day, high of the week, sell trade in the London session. This market puts in a low. So the high of the day is in, the low of the day is in. We have a low of the day. If they trade back into the low of the day, so again, understand the other 3 pairs were in downward moving markets, right? Day 1, day 2, day 3. On oil, we're on day 1, day 2, day 3. They've come back inside. Okay? They've come back inside. There's a possibility, now there's our high, there's our low, that they could work into the low for a move back up. This was an excellent short squeeze opportunities for traders, similar to what we had on Monday. So they broke through the low of the day on Monday, traded back through the low again at the open of the US window, and traded right down into the low at the New York Open for the explosive short squeeze back to the high of the lower high of the day. Difference today being is that we're in an upward moving market that's already broken down, and then they trade 1 push, 2 push, 3 push into the New York Open for an explosive short squeeze, not only back through the high of the session, but back to the high of the day and the high of the week. So again, this is an example where the market opens up inside of the high and the low and then proceeds to auction down into it. This pin inside is the open. This pin right here is when the market opens. So we're waiting for a boundary to get broken, except that they creep down into the low before breaking structure. They break structure on the inside. So if we want to call that our front side, we're trading short into the low of the day, and we have a market that is not breaking a level. It's jamming them in before breaking structure on the inside. We now potentially are on the front side of a new move. 45 minutes in to the third hour, we have a nice coiled squeeze for an explosive move back through the high of the day and the high of the week. Now this is a great example. Gold today. So day one, Monday is our high and low of the week. Tuesday goes back through the high of Monday, and we had the three levels high of day opportunity for traders yesterday. 3 pushes right into the high, which was a move back into the breakout of the inside bar from last Thursday, before getting a vertical stop hunt back into the breakout traders from the high of the day. Now this is a great example for traders to really understand the difference between retail and, I suppose, the institutional money. The institutions have positioned themselves underneath the previous day's high breakout. They auction up slowly all day long, 3 levels back to the high of the week. Some traders were looking for an explosive move back up from the creeping trend down, the high of the day from the inside bar breakout day. But the problem is, again, this market could have went vertical. But timing is so important. Timing. This market looked poised to go vertical right as we head into the open of the New York session. Day 1, day 2, day 3, high of the week, high of the day at the open of the New York session. The market breaks the previous day's high and the high of the week. It has my attention now. This potentially may offer us an opportunity when the New York market opens. We have ADP, we get peaks above the previous day's high, but the market then breaks down in the New York Open through the low of the U.S. session. We have a market that has potentially now locked in the high of the day. We've had ADP, we've already triggered the high of the day. The market did not go vertical. It's broken down with our M structure in the second hour. And then the market proceeds to auction up. And there is our reverse bullpen hammer in the second 15-minute bar after the New York Open. So again, we talk about rotation of 15-minute bars. The market is moving down. This market is no longer, the front side of this move is broken. So again, if we come back, we draw our micro trend line. If this was going, it should have went vertical. It hasn't done that. It's broken down. We are now on the back side of this move. In this peak formation after the New York Open. So at the New York Open itself, we have a nice little bullpen reverse hammer right at the open itself. Market breaks down, pulls back, and continues to auction down. Bullpen reverse hammer into 50, peak formation. We're already in a short market. I know several traders nailed this. Some people got in above 50. No problem putting starters in. The market was already breaking down as the currency pairs were heading into the open. We had our M structure already locked in, coming off of 75. 3 levels of rise. High of day, high of week has been broken. Everything inside gets you believing different things. I'm looking at 9:30 New York Open. They broke the high. It's on my list. There's my short. New York opens. We can add more positions. This market should drop back down to the low of the day. This is after the news. They've broken out. They've locked the top in. They've broken structure. They've auctioned back up, locked in the top, entered the market. A 1-bar stop. You add positions. You can still use a 1-bar stop. You can readjust your second positions on the peak formations. Once it breaks down, I'm done. Let the market do the rest, lock in profits, and get off the screen. Wasn't looking at the indexes primarily because they were range bound, and I had a feeling that we would see obviously some kind of consolidation prior to the Fed. Obviously, there was some opportunities for shorts heading out of the consolidation. Nasdaq, same thing. Nasdaq actually dropped a fair amount. We had a break of the London low, and then a pullback at the New York Open for the continuation trade short, same as the US dollar pairs. Yeah, so just to repeat, the simplest way I'm looking for opportunities are when levels are broken. Those are my best trade opportunities. I'm not trying to read the market every single day. I'm looking for markets where levels have broken and failed. When I come to my New York timing window, I want to know which pairs are set up, if they've broken a level, and is there a setup? Not just that it's at the high or the low, is there actually a decent trading setup? As we saw in the pound yen, sometimes an easy trade is just the continuation trade, the low-hanging fruit for the move back down through the low of the day. Peak formations are up. They trade back up into the high before breaking down. They trap volume away from where they're going before dropping and continuing the original move. Timing, high and low of the day. Best way for me to filter out poor quality setups, maybe pairs that aren't going to move as well, is look for pairs that have broken levels. Doesn't mean that sometimes they're not going to move. Again, we had Fed today, but I'm looking for the easier stuff. I'm not trying to read a market and trade every little move in it. Again, the US pairs didn't break levels. Of course they moved, but movement doesn't always equal a good trade setup. Those are my best trade setups come when levels are broken. Keep it simple, traders. Hopefully everybody had a good trading day. Make the rest of the week the best of the week. And have a great session. May the markets go with you.